Right now, while you're watching this, millions of Americans believe their home is their greatest investment. They point to rising property values, refinanced mortgages at historic lows, and equity lines that seem to multiply wealth from thin air. But here's what they don't see. The exact same financial scaffolding that collapsed in 2008 is being rebuilt, piece by piece, with one terrifying difference. This time, the foundation is rotting from within. In 2024, U.S. household debt hit $17.5 trillion. Mortgage debt alone accounts for $12.6 trillion of that number. Meanwhile, the average home price has increased 47% since 2020, while median household income has risen just 12%. The mathematics are brutal. We're not in a housing boom. We're in a debt trap disguised as prosperity. What if I told you that by 2026, this illusion could shatter? Not because of some external shock, but because the system was designed to fail from the very beginning. This is the economic undercurrent, where we follow the money trails that shape your world. And nothing is ever as simple as it looks. The American housing market isn't just real estate. It's a massive financial engine that transforms human shelter into tradable commodities, family homes into investment vehicles, and stable communities into speculative playgrounds. This engine runs on debt, fueled by government policy, and oiled with the promise that real estate always goes up. If you trace the flow of money through this system, from Wall Street banks to local mortgage brokers, from government-sponsored enterprises to pension funds, you discover something unsettling. The market isn't driven by supply and demand for housing. It's driven by the endless hunger for yield in a world where safe returns have been obliterated by central bank policy. To understand how this engine could seize up in 2026, we need to go back to where it all began. Not 2008, much earlier, to the moment when housing stopped being shelter and became the foundation of American finance. In 1938, Franklin Roosevelt signed a piece of legislation that would fundamentally alter the relationship between Americans and their homes forever. The National Housing Act created Fannie Mae, the Federal National Mortgage Association, with a simple but radical mission: buy mortgages from local banks, package them into securities, and sell them to investors. At the time, this seemed like financial genius. Local banks could make loans without tying up their capital for 30 years. Home buyers could access credit that would otherwise be impossible, and investors could earn steady returns backed by the full faith and credit of the US government. Everyone wins, right? But something profound had changed. For the first time in human history, the debt on your home could be sliced up, repackaged, and sold to pension funds in Tokyo or hedge funds in London. Your monthly mortgage payment wasn't just paying for your house anymore, it was feeding a global financial machine. The early decades worked exactly as promised. Post-war America saw the greatest expansion of home ownership in history. Veterans returned from World War II to find government-backed mortgages waiting for them. Suburbs exploded across the landscape. The 30-year fixed-rate mortgage became as American as apple pie. By the 1970s, this system had created something unprecedented, a middle class built on debt. But that debt felt safe because it was secured by real estate, and real estate, everyone knew, always went up. The government guaranteed it. The banks promoted it. The culture celebrated it. Then came the innovation that would eventually destroy everything: securitization on steroids. In 1970, Ginnie Mae issued the first mortgage-backed security. By 1981, Wall Street had discovered something intoxicating. You could take thousands of mortgages, bundle them together, slice them into tranches, and sell pieces to different investors based on their risk tolerance. The safest pieces went to conservative pension funds. The riskiest pieces went to speculators chasing higher yields. This wasn't just financial engineering, it was alchemy. You were taking individual mortgage loans, each tied to a specific house and a specific family, and transforming them into abstract financial instruments that could be traded like commodities. The connection between the homeowner making payments and the investor collecting returns became so complex that no one understood it completely. But here's where the story gets dark. Once mortgages could be packaged and sold, banks no longer cared about the quality of the loans they were making. Why would they? Within weeks of closing, the mortgage would be sold to Wall Street, packaged into a security, and scattered across global markets. The bank kept the fees and passed along the risk. This created a perverse incentive structure that would define the next 4 decades. Banks were rewarded for making more loans, not better loans. Real estate agents were rewarded for higher prices, not sustainable prices. Rating agencies were paid by the very companies whose securities they were supposed to evaluate objectively. By 2000, this machine was running at full throttle. Mortgage origination hit $2 trillion annually. Home prices were rising 10–15% per year in major markets. Financial television featured regular Americans bragging about flipping houses for quick profits. The idea that real estate could decline seemed as absurd as suggesting that gravity might reverse. But the machine needed fuel. It needed more borrowers, higher prices, and ever greater quantities of debt to feed the global appetite for mortgage-backed securities. When qualified borrowers became scarce, the industry simply lowered the standards. Ninja loans, no income, no job, no assets verification, became commonplace. Interest-only mortgages proliferated. Adjustable-rate mortgages with teaser rates pulled in borrowers who could never afford the reset payments. The housing market had become a Ponzi scheme, but one that appeared legitimate because it was backed by the most powerful financial institutions in the world and blessed by government policy. Every participant believed they were making rational decisions. Homebuyers thought they were building wealth. Banks thought they were managing risk. Investors thought they were buying AA-rated securities backed by American real estate. The system worked perfectly until it didn't. In 2006, the machine began to sputter. Home prices started declining. Mortgage defaults began rising. The complex derivatives built on top of mortgage securities started unraveling. By 2008, the entire global financial system was on the brink of collapse, all because Americans couldn't make their mortgage payments. The crash was devastating. Home prices fell 30% nationally, with some markets declining 50% or more. 9 million families lost their homes to foreclosure. Banks failed. Investment firms evaporated overnight. The government was forced to implement the largest financial bailout in history to prevent a complete economic collapse. But here's what's crucial to understand. The response to the crisis didn't fix the underlying problem. It made it worse. After the smoking ruins of 2008, you might expect the financial system to fundamentally change. You might expect stricter lending standards, smaller banks, and a return to the quaint idea that mortgages should be held by the banks that make them. Instead, the opposite happened. The government response to the housing crash was to make housing more financialized, not less. The Federal Reserve cut interest rates to zero and kept them there for nearly a decade. This wasn't just monetary policy, it was a direct subsidy to the housing market. When you can borrow money for essentially free, asset prices must rise. It's mathematical inevitability. But the real innovation came from an unexpected source: institutional investors. In 2012, as millions of foreclosed homes hit the market at fire sale prices, Wall Street made a discovery that would reshape American housing forever. Private equity firms like Blackstone began buying thousands of single-family homes, not to flip them, but to rent them out as a new asset class, single-family rental. This was brilliant financial engineering. Instead of buying apartment buildings that required management and maintenance, these firms could buy suburban homes and rent them to the same families who might have previously owned them. The rental income provided steady cash flow, while the underlying real estate provided appreciation potential. By 2024, institutional investors own over 7 million single-family homes across the United States. That's not just a number, it's a fundamental shift in who controls American housing. These firms don't buy homes to live in them, they buy homes to extract wealth from them. But the real mechanism driving today's housing market isn't institutional ownership. It's something far more subtle and dangerous: the everything bubble. Here's how it works. Since 2008, the Federal Reserve has pumped over $8 trillion into the financial system through quantitative easing and near-zero interest rates. This money doesn't sit idle. It searches desperately for yield in a world where traditional safe investments like treasury bonds pay almost nothing. Real estate becomes the obvious choice. Not just residential real estate, but commercial real estate. real estate investment trusts, real estate development companies, and complex derivatives based on real estate values. When pension funds need 7% returns to meet their obligations, but Treasury bonds pay 2%, they have no choice but to chase risk. This creates a feedback loop that's impossible to break through normal market forces. Low interest rates make borrowing cheap, which drives up asset prices, which attracts more investors, which drives up prices further. Each step in the cycle feels rational to the individual participants, but the collective result is a bubble that must eventually pop. Meanwhile, the mortgage market has evolved in subtle but crucial ways. Today's mortgages aren't just packaged into simple mortgage-backed securities. They're bundled into collateralized mortgage obligations, synthetic CDOs, and exotic derivatives that make the 2008-era financial instruments look simple by comparison. The rating agencies that rubber-stamped worthless securities in 2008 are still operating under the same business model. They're paid by the issuers they're supposed to evaluate. The banks that made reckless loans before the crash have grown larger and more powerful. The government-sponsored enterprises that were supposedly reformed after their near collapse are now larger and more systemically important than ever. But there's a new player in this game that makes it infinitely more dangerous: technology companies. iBuying, instant buying, emerged around 2015 with companies like Opendoor and Zillow Instant Offers. These companies promise to revolutionize real estate by using artificial intelligence to make instant cash offers on homes, eliminating the uncertainty and hassle of traditional sales. The business model seems straightforward: use sophisticated algorithms to determine fair market value, buy homes slightly below market, make minor improvements, and resell for a profit. Scale this across thousands of transactions, and you create a new kind of real estate machine powered by data rather than human judgment. But iBuying revealed something terrifying about modern real estate markets. They're driven by algorithms that no human fully understands. When Zillow's iBuying program collapsed in 2021, forcing the company to sell thousands of homes at massive losses, it wasn't because of market manipulation or fraud. It was because their artificial intelligence systems fundamentally misunderstood how real estate markets work. Here's what's frightening about that failure. If Zillow's algorithms, powered by more real estate data than any company in history, couldn't accurately price homes, what does that tell us about the stability of current home values? Today's housing market operates on three critical assumptions that may all be false. First, that artificial intelligence can accurately predict real estate values in real time. Second, that institutional investors can continue absorbing single-family homes without eventually distorting local markets beyond recognition. Third, that interest rates can remain artificially low indefinitely without creating massive asset bubbles. The mortgage market today processes over $4 trillion annually, double the volume that existed at the peak of the 2008 bubble. Home prices have risen 47% since 2020 alone. Household debt service payments consume 9.8% of disposable income, approaching the dangerous levels seen before previous crashes. But the most ominous indicator isn't visible in traditional economic data. It's the growing disconnect between housing costs and the underlying economy that supports them. In markets like Austin, Phoenix, and Boise, homes are priced as if local incomes will double within 5 years. The math doesn't work unless you believe that real estate has become completely divorced from economic fundamentals. That's exactly what happened in 2006, and it's happening again now. The real secret that no one talks about, not real estate agents, not mortgage brokers, not financial television hosts, is that every debt-driven bubble has a mathematical endpoint. It's not a mystery when it will arrive, it's a question of arithmetic. Here's the brutal calculation that keeps economists awake at night. American households can only service so much debt before they break. That breaking point isn't subjective, it's mathematical. When debt service payments consume more than 15% of disposable income, defaults spike. When housing costs exceed 40% of household income, demand collapses. When house prices rise faster than incomes for more than 7 consecutive years, corrections become inevitable. We're approaching all three thresholds simultaneously. Consider what's happened since 2020. The average monthly mortgage payment has increased from $1,400 to $20,300, a 64% increase in just 4 years. Meanwhile, median household income has risen from $68,700 to $76,330, an 11% increase. The gap is mathematically unsustainable. But this isn't just about affordability. It's about the debt saturation point, the moment when the economy can no longer absorb additional debt without triggering systematic defaults. Japan reached this point in 1989. Real estate prices had risen for 15 consecutive years, driven by bank lending and government policy. Japanese families were taking out 100-year mortgages to afford homes in Tokyo. Commercial real estate was so expensive that the Imperial Palace grounds were theoretically worth more than all the real estate in California. Everyone knew it was insane. But everyone also believed that Japanese real estate was different. Limited supply, growing wealth, cultural preference for ownership, government support. The justifications were endless and seemingly rational. Then, in 1990, the Bank of Japan raised interest rates from 2.5% to 6%. Real estate prices didn't just fall, they collapsed and stayed down for 30 years. Japanese property values today remain 60% below their 1989 peaks. An entire generation of Japanese families is still underwater on mortgages they took out 3 decades ago. The United States hit its first debt saturation point in 2006. Household debt service payments reached 13.2% of disposable income, the highest level ever recorded. Home prices were rising 15% annually, while incomes grew at 3%. Credit standards had deteriorated so severely that banks were lending to borrowers who couldn't document any income. The crash that followed wiped out $6 trillion in household wealth and triggered the worst recession since the 1930s. But the government response prevented the natural deleveraging that should have followed. Instead of allowing debt levels to fall back to sustainable levels, policymakers flooded the system with even more liquidity. Today, we're approaching a second debt saturation point, but this one is different. It's not just individual families that are over-leveraged. It's the entire financial system that depends on ever-rising real estate values. State and local pension funds have $1.8 trillion invested in real estate and real estate-related securities. That's not play money. It's the retirement security of teachers, firefighters, and police officers. If real estate values fall 30%, hundreds of pension funds become insolvent overnight. Commercial real estate presents an even more immediate threat. Over $1.5 trillion in commercial mortgages are scheduled to reset to higher interest rates between 2024 and 2026. Many of these loans were made when interest rates were near zero. As they reset to current market rates, thousands of office buildings, shopping centers, and apartment complexes will become financially unviable. But the real-time bomb is hidden in plain sight: the mortgage servicing market. Here's how mortgage servicing works. When you make your monthly mortgage payment, it doesn't go directly to the bank that made the loan or the investors who own the mortgage-backed security. It goes to a servicing company that collects payments, handles escrow accounts, manages defaults, and eventually forecloses if necessary. These servicing companies make money on volume, not performance. They earn a fee, typically 0.25% to 0.50% for each mortgage they service, regardless of whether borrowers actually make their payments. This creates a perverse incentive. Servicers want to manage as many mortgages as possible, while spending as little as possible on the infrastructure to service them properly. During the 2008 crisis, mortgage servicing companies proved completely incapable of handling mass defaults. Phone systems crashed, document processing ground to a halt. Millions of families who wanted to negotiate loan modifications couldn't even reach a human being at their servicing company. Today's mortgage servicing industry is larger, more complex, and more fragile than it was in 2008. The top 5 mortgage servicers manage over $7 trillion in outstanding loans, more than the entire US banking system held just 20 years ago. These companies have invested heavily in automated systems designed to handle routine payments, but they remain completely unprepared for mass defaults. When the next housing downturn begins, it will create a cascading failure across the entire servicing infrastructure. Borrowers who fall behind on payments will discover that their servicers are too overwhelmed to process loan modifications. Families who want to sell before foreclosure will find that their servicers can't provide clear title documents. Investors who own mortgage-backed securities will realize that they have no idea who actually owns the underlying properties. This isn't speculation. It's exactly what happened during the 2008 crisis, and the underlying problems have gotten worse, not better. The debt saturation point isn't just about individual borrowers defaulting on their mortgages. It's about the moment when the entire system becomes too complex and leveraged to function properly. We're rapidly approaching that threshold. Consider the mathematics. If housing prices fall just 20% from current levels, approximately 7 million homeowners would be underwater on their mortgages. That's 7 million families who owe more than their homes are worth, removing them from the potential buyer pool just when the market needs buyers most. If mortgage rates rise to 8%, still below historical norms, monthly payments on a median-priced home would increase by $800. That would eliminate approximately 15 million potential buyers from the market based on standard debt-to-income ratios. If commercial real estate values fall 30%, roughly what happened during the 2008 crisis, the losses would exceed $2 trillion. That's larger than the GDP of most countries, and enough to threaten the stability of major financial institutions. These aren't worst-case scenarios. They're mathematical probabilities based on historical patterns and current leverage levels. The hidden truth is that debt-driven bubbles don't deflate gradually. They pop suddenly when debt service becomes impossible for a critical mass of borrowers. We're not slowly approaching that point, we're racing toward it. Fast forward to today, and the parallels to previous housing crashes are undeniable. But 2026 won't be a repeat of 2008. It will be something entirely new and potentially far worse. The timeline is already being written by forces completely outside the control of real estate markets. Between 2024 and 2026, over $2.1 trillion in commercial real estate loans will mature and require refinancing. Most of these loans were originated when interest rates were near zero. They'll be refinancing into a world where commercial mortgage rates are 7 to 8%. Do the math. A $10 million commercial mortgage that was paying 3% interest now faces refinancing at 7 to 8%. That's not just a payment increase, it's a property value collapse. Commercial real estate is valued based on income relative to interest rates. When rates double, values must fall by 30–40% just to maintain the same return to investors. But commercial real estate isn't isolated from residential markets. When office buildings become worthless, banks fail. When banks fail, credit tightens. When credit tightens, fewer families can qualify for mortgages. When fewer families can buy homes, residential prices fall. The pattern is always the same. Commercial real estate crashes first, then residential follows within 18 to 24 months. Meanwhile, a different kind of time bomb is ticking in Washington. The Federal Reserve has painted itself into a corner with monetary policy. Inflation remains above target, but unemployment is rising. They need to cut interest rates to support employment, but cutting rates will reignite inflation and further inflate asset bubbles. This is the classic central bank trap. They can fight inflation or support asset prices, but not both simultaneously. Historically, central banks choose to fight inflation, even if it means crashing asset markets. When Paul Volcker raised rates to 20% in 1980, he triggered a severe recession, but broke the back of inflation. Jerome Powell faces the same choice today. The political calendar makes this even more dangerous. The 2024 election cycle has made honest discussion of financial risks politically toxic. No politician wants to be responsible for talking down real estate values. No Federal Reserve official wants to trigger a crash during an election year. This political paralysis means that problems that could be addressed gradually are being allowed to metastasize. Every month that passes without policy changes makes the eventual correction more severe. But the real difference between 2026 and previous crashes is the role of algorithmic trading in real estate markets. Today's property values aren't just determined by human buyers and sellers making emotional decisions. They're increasingly driven by computer algorithms, making millions of trading decisions based on complex mathematical models. When Zillow's algorithms misread the market in 2021, the company was forced to sell 7,000 homes at massive losses within a few months. Now imagine what happens when dozens of algorithmic trading systems all try to exit real estate positions simultaneously. The cascade effect could trigger price declines that are faster and more severe than anything in recorded history. High-frequency trading has already transformed stock markets, bond markets, and commodity markets. It's now transforming real estate markets, but with a crucial difference: houses can't be sold instantly like stocks. When algorithmic systems want to exit real estate positions quickly, they have to slash prices dramatically to find buyers. The data showing this transformation is hiding in plain sight. In major markets like Phoenix, Austin, and Miami, over 25% of home purchases in 2024 were made by entities using algorithmic pricing models. These aren't traditional investors making careful decisions about individual properties. These are computer systems making split-second decisions based on data feeds and mathematical models. When these systems start selling instead of buying, which they will when their models detect declining values, they'll create a feedback loop that human buyers can't counteract. Algorithmic selling will drive down prices, which will trigger more algorithmic selling, which will drive down prices further. But perhaps the most dangerous parallel to previous crashes is the growing disconnect between housing costs and the economic fundamentals that support them. In 1989, Japan, property values assumed perpetual economic growth and unlimited bank lending. In 2006, America, property values assumed perpetual appreciation and unlimited credit expansion. Today's American housing market assumes something even more fantastic: that the Federal Reserve can maintain near-zero real interest rates indefinitely while inflation remains contained and asset prices continue rising forever. This assumption is baked into every financial model, every pension fund allocation, every insurance company reserve calculation, and every bank capital requirement. The entire financial system now depends on real estate values that only make sense if interest rates never rise and inflation never returns. But inflation has returned. Real interest rates, after adjusting for inflation, remain negative, but that can't continue indefinitely without destroying the currency itself. When real interest rates return to historical norms of 2 to 3%, asset values must fall dramatically to provide competitive returns. The Federal Reserve knows this. They've published research showing that current asset valuations are extremely elevated relative to historical norms. They understand that normalized interest rates would trigger significant asset price declines, but they also know that raising rates aggressively would trigger immediate economic pain. So they're trapped in what economists call the bubble preservation paradox. They must keep inflating the bubble to prevent it from popping, but every day they keep it inflated makes the eventual pop more devastating. The international dimension makes this even more complex. Foreign investors now own over $4.5 trillion in U.S. real estate and real estate-backed securities. When American property values start falling, these investors will face enormous pressure to sell and repatriate capital to protect their home currencies. China alone owns over $1.2 trillion in U.S. real estate assets through various investment vehicles. If geopolitical tensions continue escalating, Chinese entities could be forced to liquidate these holdings rapidly, regardless of market conditions. The pattern is crystal clear to anyone willing to look. 2026 represents the convergence of multiple mathematical inevitabilities. Commercial loan maturities will force refinancing at much higher rates. Pension fund obligations will require returns that current asset prices can't sustainably provide. Federal Reserve policy will face impossible trade-offs between inflation and employment. Algorithmic trading systems will amplify any decline through automatic selling. Most importantly, American households are approaching the debt saturation point where additional borrowing becomes mathematically impossible. When families can't borrow more money to buy houses at current prices, demand must collapse. The rhyme with previous crashes is clear, but the scale and complexity of this crash could be unlike anything in recorded history. We're not just dealing with over-leveraged households, we're dealing with over-leveraged institutions, over-leveraged pension funds, over-leveraged governments, and over-leveraged central banks all at the same time. So how do you protect yourself when the inevitable crash arrives? In every previous housing crash, certain types of people not only survived but thrived. The survivors shared specific characteristics that had nothing to do with luck and everything to do with understanding how financial systems really work. During the Japanese real estate collapse of the 1990s, survivors had three things in common. They held liquid assets, they avoided debt, and they maintained income streams independent of the real estate industry. The families who had been conservative, who hadn't borrowed against their homes, who hadn't leveraged themselves to buy rental properties, they were positioned to buy quality assets at fire sale prices. In the 2008 American housing crash, the survivors were even more specific. They held cash when everyone else was holding mortgages. They rented when everyone else was buying. They worked in industries that benefited from economic disruption rather than depending on the continuation of the bubble. Warren Buffett exemplified this approach perfectly. While banks were collapsing and real estate values were cratering, Berkshire Hathaway deployed over $50 billion in cash to buy quality assets at deep discounts. Buffett didn't need to predict the exact timing of the crash. He just needed to be prepared when it arrived. The constant principle across all crashes is this: survival belongs to those who are positioned opposite to the crowd when the crowd is most convinced they're right. Today, the crowd believes that real estate is a safe long-term investment, that mortgage debt is good debt, and that home prices may fluctuate but will always recover. The survivors of the coming crash will be positioned opposite to every one of these beliefs. Let's be specific about what survival looks like in 2026. Liquid assets over real estate. The survivors will hold significant cash reserves when credit markets freeze. Not bank deposits that might be subject to bail-ins or bank failures, but actual liquid assets that can be deployed quickly when opportunities arise. This might be money market funds, short-term treasury bills, or even physical cash for truly catastrophic scenarios. The psychological challenge is enormous. Holding cash while real estate prices are still rising feels like losing money every day. Your neighbor's house goes up $50,000 in value while your savings account earns 2% interest. It requires tremendous discipline to maintain liquidity when everyone around you is leveraging up. But remember the mathematics. If housing prices fall 40% and you've been holding cash, you haven't lost money. You've gained 40% in purchasing power relative to real estate. The survivors understand that preservation of capital is more important than maximization of returns when you're approaching a debt saturation point. Income independence. The survivors will have income streams that are independent of the real estate bubble economy. This means avoiding careers that depend on continuous property appreciation, real estate sales, mortgage lending, construction, property development, and real estate investment. More subtly, it means avoiding any career that depends on consumer spending fueled by home equity extraction. When home values fall, families can't borrow against their homes to fund consumption. Retail, restaurants, luxury services, and discretionary spending all collapse during housing busts. The safest careers during housing crashes are those that provide essential services or that benefit from economic disruption. Healthcare, utilities, basic food production, debt collection, bankruptcy law, and distressed asset management. Strategic positioning for opportunity. The real winners during housing crashes don't just avoid losses, they profit from the distress of others. This sounds harsh, but it's mathematical reality. When over-leveraged investors are forced to sell quality assets at fire sale prices, someone has to be the buyer. During the 2008 crash, investors who had prepared for the opportunity were able to buy quality rental properties for 40–60% below their previous values. They acquired cash-flowing assets that would generate income for decades at prices that may never be seen again. The key is preparation. You can't wait until the crash begins to position yourself for opportunity. By then, credit will be frozen, seller financing will be impossible, and competition for quality assets will be intense among the few buyers who remain. Geographic arbitrage. The survivors understand that not all real estate markets crash equally. Some locations hold value better than others based on underlying economic fundamentals rather than speculative mania. Areas with diverse economies, Growing populations and limited land supply tend to recover faster than areas dependent on single industries or areas with unlimited development potential. Cities with major universities, military bases, or government employment provide more stable demand than cities dependent on real estate speculation or resource extraction. The most sophisticated survivors will position themselves to benefit from geographic price disparities. As high-cost areas crash, lower-cost areas with better fundamentals become relatively attractive. Someone who can relocate from an overpriced coastal market to an undervalued interior market can dramatically improve their financial position. Debt avoidance at all costs. Most importantly, the survivors will enter the crash with minimal debt exposure. This means no adjustable rate mortgages, no home equity lines of credit, no investment property mortgages, and no consumer debt secured by real estate. Fixed-rate debt can actually be beneficial during inflationary periods, but only if you can service the payments regardless of what happens to the collateral value. If your income depends on the real estate bubble economy, even fixed-rate debt becomes dangerous. The psychological challenge is that debt avoidance requires saying no to opportunities that seem obviously profitable. When your neighbor is buying rental properties with 5% down and generating positive cash flow, it takes enormous discipline to remain debt-free. But debt is what transforms market volatility into personal catastrophe. The families who lost their homes in 2008 weren't the ones who saw their property values decline. They were the ones who couldn't make their mortgage payments when their values declined. Here's the truth that no one wants to hear. The coming housing crash isn't a natural disaster that randomly destroys wealth. It's a wealth transfer mechanism that moves money from the leveraged to the unleveraged, from the unprepared to the prepared, from those who believed in the permanence of the bubble to those who understood its mathematical inevitability. The question isn't whether you'll survive the crash, it's whether you'll be positioned to benefit from it. The truth is that housing crashes aren't unpredictable natural disasters. They're mathematical inevitabilities that arrive when debt service becomes impossible for a critical mass of borrowers. Every bubble in history has followed the same pattern. Easy credit creates artificial demand. Artificial demand drives up prices. Rising prices attract speculation. Speculation creates more demand, and the cycle continues until debt service consumes too much income to sustain. We're not approaching that point gradually. We're racing toward it at accelerating speed. The question isn't whether the 2026 housing crash will happen. The mathematics make it inevitable. The question is whether you'll be prepared when it arrives. Consider the numbers one more time. Mortgage debt has increased 15% annually since 2020, while incomes have grown 3% annually. Commercial real estate faces $2.1 trillion in refinancing over the next 24 months at interest rates 4.5 percentage points higher than the original loans. Pension funds need 7% returns to meet obligations, but have committed to real estate investments that can only provide those returns if property values continue rising indefinitely. The mathematical impossibility is staring us in the face, but financial incentives prevent anyone in the industry from acknowledging it publicly. History doesn't repeat exactly, but it rhymes with terrifying precision. The debt saturation point approaches whether we acknowledge it or not. The only variable under your control is your position when the music finally stops. If this gives you a new perspective on what's really happening in American real estate markets, hit subscribe. History has the answers. I'll show you where to look. The crash is coming. The only question is whether you'll be ready.